but it's understated because, you know, GDP is a final sales concept. So let's say it's $120 trillion. You can't put $120 trillion on a single public chain. Uh-huh. Because, Ethereum would be worth, you know, $20 million because there would be so much value locked on it. So there will be room for more than one L1. But Ethereum has been the place that has captured more than two-thirds of all creations. It has had 100% uptime, and almost every project that has been announced is a layer 2 on Ethereum. So, I mean, I'm not against Solana or Avalanche or these other chains, but as an institutional grade blockchain, Wall Street is building on Ethereum. As Tom explains, 70% of tokenization today flows through Ethereum, BlackRock, Goldman, Robinhood. All roads lead to the same settlement layer. That's why BIT, likely a reference to a company, is accumulating 3.2 million ETH and locking it in staking for yield, positioning Ethereum as the base layer for everything to come. After listening to him, the analogy becomes clear. Bitcoin is the reserve, Ethereum is the rails. When Wall Street rebuilt finance around the dollar, it sparked a generation long boom. Now it's rebuilding finance around code, and ETH is the monetary base for that system. Tom's $21,000 target isn't hype, it's arithmetic. If Ethereum simply recovered its historical ratio with Bitcoin, that's where it would land. The bigger story is that institutions are already migrating. They just haven't told the retail crowd yet. And if you want to stay one step ahead of the market to spot when it's overheating or those rare buy signals are flashing, join Crypto Nutshell, my free 5-minute daily newsletter. You'll get quick, actionable insights and the latest news that's actually moving the markets, all delivered straight to your inbox every single morning. Just click the first link in the description and enter your email to join. Let's get back to the video. Markets are at all-time highs. Earnings are strong. Liquidity is expanding. And yet the sentiment feels like 2008. This is, as Tom calls it, the most hated rally ever. I can prove empirically that it's the most hated. One of the best measures of large investor sentiment is the AAII Net Bulls Index Bulls minus Bears. It's been running for 40 years. This year, it has averaged minus 11.7. So every week, the weeks this year. There are only 3 other times in the last 40 years where it registered minus 11.7 or less. 1990, 2008, and 2022, all bear market years. So, the sentiment looks like a bear market, and the market is up double digits year to date. Why is it the most hated? I think we show it in our research. It's based on political division. So the country is 50/50 Republican/Democrat. But in the equity world, and there's Pew Research data on this, 57% of professional money managers are Democrats, 66% of hedge funds are Democrats, and something like 69% of venture capital funds are Democrats. Interesting. So the risk capital world did not vote for Trump. So they see his policies as those of someone who destabilizes the economy. In the bond market, it's the opposite. 80% of credit managers are Republicans. That's why this year the bond market hasn't been. High yield spreads have been stable. Credit spreads have been stable. But the equity market has been volatile. I mean, it's fascinating to think about. I think the generalization is that Republicans are business and investors and, things like that. And they're the ones going all in on risk because of these policies. But what you're actually arguing is no, the majority of hedge fund and venture capital managers are Democrats, and they are just very defensive. They are actually negative on the potential outlook. Yes. And so, in a strange way, politics is rotting some people's brains in terms of looking objectively at the market. Yes. And you can see it perhaps in the economic commentary this year. How many economists said, oh, tariffs will cause a recession or tariffs will cause an inflation spike? This is actually a very subjective argument because tariffs are a tax. And if we treat them as a tax, taxes are not inflationary. So we never say they are inflationary. But the economists describing it as inflationary are, I think, taking a specific view that makes it an inflationary argument. So in other words, there's a kind of bias in that statement. In March and April, was very clear that tariffs would not be inflationary. And I found out weeks later that journalists, people I knew, no one wanted to ask me directly. So they asked people who work here in our office. Does he really believe this stuff? Is he crazy? Or something? And I was like, I'm just looking at the data. I laid it out there, and now in hindsight, I realized it was the political viewpoint assessing it. And there was an article that was written, and someone wrote, you know, uh, MAGA shill, or whatever the terminology was. And I was like, I'm like the most in depth as it's constantly said, independent, whatever. But it was just like if you believed tariff policy was good. You were immediately put in a political bucket. It's fascinating then to think about how people allocate their capital, and it actually creates brain rot in quant systems, because quant systems draw from published commentary, so they see inflation. So they train the machines to think it's inflationary when it's not, and they interpret everything, so it's polluting the entire lens. And I think it has influenced how equity risk managers, managed risk. His data proves it. Investor sentiment averaging minus 11.7, a level usually seen in deep bear markets. But the S&P is up double digits. The disconnect isn't economic, it's emotional. Tom's research links it back to politics. Most professional money, hedge funds, VCs, asset managers lean one way politically, and they simply don't like the current political context. Their bias becomes their forecast. Meanwhile, the credit markets, dominated by the other side, show no fear. Tight spreads, healthy flows, stable risk. When ideology infects models, even algorithms start trading narratives instead of numbers. That's why rallies born in doubt often end in disbelief, and why the biggest gains come when sentiment is most divided. Markets don't move on feelings, they move on liquidity. In every idea, Tom's message converges on a theme. This isn't a bubble, it's an evolution. AI is rewriting productivity. Gold and Bitcoin are uniting the old and new monetary bases. Ethereum is becoming the infrastructure of tokenized finance. And market skepticism is setting the stage for the next great expansion. Tom Lee's edge has always been simple: ignore the noise, follow the data, and understand the cycles. Every time investors call the top, they forget that innovation plus liquidity never dies quietly. The world isn't overvalued, it's still catching up to what has already changed. And, as always, disbelief gets liquidated.